watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Victor Seanie from Benguela Global Fund Managers and Chantal Marx from FNB Wealth and Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Chantal, Victor, thanks so much for your time this afternoon. And Chantal, let's start with you. Now, we've wrapped up, another week of trade, Nvidia's results and economic data top of mind. Let's start with the U.S. economy. Growth there expanding 3.3% in the second quarter. Now, this is the second estimate for the quarter, beating forecasts and a strong turnaround from Q1 where growth actually, or there was no growth actually, contracted 0.5%. Just walk me through what you made of that print. We are seeing that the consumer is still somewhat spurring growth on that front.
Yeah, so consumption certainly holding up well, and that's in keeping with some of the other higher frequency economic data that we've been seeing out of the US. I think where the concern for the US is right now is it's basically twofold. So the first thing is the labor market.
Yes.
There we'll have a lot more clarity next week when we get fresh payrolls data, but the revisions for the last 2 months were deeply negative. And it's quite tricky because you also have a contraction in supply of labor due to the clampdown on immigration. And we're not really sure how that demand and supply dynamic is interacting right now. And then additionally, inflation is a concern.
Yeah.
Are we going to get tariff-related inflation? And if we do, is it going to be one-off like a VAT hike, or is it going to become entrenched? And we'll start getting an idea of tariff-related inflation in the personal consumption expenditure data that's coming out later today.
With that PCE print in focus. And on those tariff dynamics then, Victor, how would you say the consumer is going to hold up moving forward? I'm just reflecting on some of the U.S. retail numbers that we got last week that were quite mixed. Now, we're seeing in Home Depot where consumers are spending less when it comes to home renovations. But you look at the numbers from Walmart, which were quite good, and it also speaks to, I guess, buying necessities, what you actually need. Walmart also, in the meantime, taking in those tariff hits and not passing them down to consumers. How long can they do that? And will we continue seeing the U.S. consumer in this healthy state?
Yeah, I think that the strongest retailers such as Walmart are in the best position because of their scale, because of their supply chain efficiency to negotiate acceptable cost increases from their suppliers who are being affected by tariffs. I think that consumers also are trading down from your higher price retailers to your Walmarts. One example thereof can be seen in Target's results. Target, which has historically been a higher price retailer than Walmart, having a very difficult time at the moment. And we see that. I think going forward, consumers will still, they haven't yet felt the full brunt of the tariff.
Yeah.
I think the worst is yet to come. So companies are still going to pass on. And the passing on of tariff costs among companies is a gradual exercise. Do it on day one. So they probably stomach some of it earlier on, as we've seen with some companies. But then over time, they would take a gradual approach to passing on those costs to consumers. So the U.S. consumer could well still be under pressure for the next 12 months or so. And it'll take a little while before the consumer sentiment numbers tick up in the U.S., in my view.
And with that being said then, Victor, do you expect to see growth in the U.S. slowing in Q3 and Q4?
I think most likely, especially if we don't get more than 125 basis point rate cut from Powell in September. I would suspect a fair amount of the GDP explosion, sorry, that's probably a strong word, in Q2. Well, at least above expectation.
Yeah.
I think we are in an anomalous economy in the U.S., given the disruption that's been brought about by tariffs. And in the Q2 number, I think there's a significant amount of forward buying, a lot of buying up, a lot of acceleration of economic activity in the second quarter as companies brace themselves for perhaps slower growth in the rest of the year.
So the pressure really is on for, on what's this, Fed Chair Jerome Powell. And yeah, I guess we'll see what he'll do. Firstly, we'll see those PCE figures and then the labor print, and then hopefully we'll see what he does come, I think, September 17th, 18th, around there. All right, let's move over to the tech sector with a look at Nvidia bumper numbers. But there always seems to be a disconnect, Chantal, right? With the share price under pressure when those numbers are released. What's the reason behind that? Are markets just expecting more? I mean, we've moved from, triple-digit earnings growth to now double-digit earnings growth. Listen, it's still good, but I don't think it's good enough for markets.
No, so I mean the base is exceptionally high, right? And you need to understand that the growth rate will probably slow, even though the absolute addition of incremental revenue and earnings will still be large, and perhaps even bigger than the previous years. But the base is very big, so the rate of change, I think, it's very natural for that to slow over time. It's an exceptionally large company now, right? So it becomes a lot more difficult to print 70-80% earnings growth when you consider just the sheer size. So there's that. I think the market understands that. And if you look at market estimates going forward, there is that tempering of growth. Nvidia's results were better than expected on the top line and on the bottom line. And guidance was also actually ahead of expectations. I think what the market is worried about, and not too worried about, by the way, because we're used to actually seeing 6, 7, 8% swings in Nvidia's share price post-earnings. So a 1% dip in the share price is not the end of the world. But what the market could be concerned about is just the outlook for China. So H20 chips, they didn't sell any in the second quarter, not surprising. There was a ban. They are also not including any sales in their forecast for the third quarter. The reason being that they're still unsure around the regulatory story. And also the Chinese have indicated that, well, maybe we don't want your H20 chips, because while that ban was in place, and probably before that, with the threat of a ban being implemented, they've been developing their own technology. And Nvidia's warned about this. They've said, if we cannot sell into China, they will develop the technology themselves and they will displace us. And it does seem as if that narrative is playing out somewhat.
All right. There's a question here on Nvidia, Victor. The viewer says, having bought Nvidia in June 2020, I am now on the verge of a 2,000% gain and am tempted to take the money and run before I lose that chance of bagging a 20 bagger. Is there any chance that this company is a hold and might just become a perennial like Microsoft did?
Yeah, I think the starting point is pretty elevated. Nvidia is sitting on a P ratio of about 58 now. I think, and this is a P ratio on rich earnings at its highest ever operating margins. So the potential for further improvement from these levels, probabilistically speaking, is not that high. So I would probably. Congratulations on the very impressive investment you made. But I would trim to at least, So I would diversify from this point forward. If Nvidia were to double from this point, it'll be close to becoming the most valuable company of all time. I saw a statistic the other day that the highest market cap company of all time in real terms was the Dutch East India Company of a market cap of about $10.4 trillion. So Nvidia could get there, but on the balance of probabilities, I would think it's unlikely. I could be wrong, but that's just my.
All right, let's move over to some local counters, zooming in on PGM stocks. Chantal, is it a good time to buy Sibanye at these levels? The group out with earnings yesterday. I mean, the miner did manage to narrow its losses, and the metal cycle seems to be working somewhat in their advantage. Gold is on a tear. We are also seeing a recovery in platinum prices this year.
Yeah, I mean, so the Sibanye results were actually very interesting because the PGM side of it was complemented by some kind of environmental credits or local tax credits. It wasn't actually environmental. Let's face it, the US administration does not they've changed their tune on that, but they've had some tax credits coming through on that side, which really complemented the profitability there. On the gold side, they had very high gold prices, so that helped them, but production has come under pressure due to some operational challenges at Kloof, so they're not fully benefiting from that high gold price. That said, they're a marginal producer, so very high gold prices will continue to be supportive for them, and the PGM pricing cycle looks a lot more favorable at the moment. So I think that they'll do okay. Their debt levels also improved a little bit, so there is that, and then their kind of future-facing metals story they're still working on. It's a high-risk story still, so you need to hold on to your hat. And you probably need to withstand some volatility there. I think if I'm looking for exposure longer term to gold and PGMs, Sibanye would probably not be my pick, but it is one of those companies that will do well if gold prices are sustained at current levels and we continue to see a push higher in PGM prices.
What about you then, Victor? What do you think about Sibanye and maybe the other players in that PGM space? We've seen numbers out from a whole lot of them, Impala Platinum. Today we had numbers out from Northern Platinum. Profits under pressure. We are seeing that on the back of the lower metal prices during that period. But as mentioned, we are starting to see somewhat of a recovery in the platinum price going into 2025.
Yeah, I would say at this stage, we perhaps could say that we are comfortably past the very bottom of the platinum price cycle, and the lowest quality counters typically perform best off the bottoms. That the Sibanye compared to the higher quality players such as Valterra and North Impala. So when we get to this stage of the cycle where we're still in the upturn, the platinum price is round about its 10 and 20-year average price, basket price, but we know that things overshoot on the upside and the downside. So we may still continue to go upward from here, but I would probably think this is a good time to rotate from the lower quality players like Sibanye into Valterra and Northam possibly. So So I think it's still fine to take an overweight position in platinums, but the high quality players.
Capital appreciation, and I'll give that one to you, Chantal, one of the smaller players on the JSE, but I guess an interesting, fintech player, and the viewer asking you to provide 2 reasons for one to buy capital appreciation and 2 reasons for one not to buy capital appreciation.
Okay, great. No, I mean, Capital Appreciation is a great little company. It's one of the only SPAC success stories on the South African exchange, and they continue to grow quite strongly. So my first reason would be you will probably continue to see really strong growth out of their payments business. And the second reason backs that up in that the technology that they are providing is proprietary to them, and they really are challenging the space, particularly when it comes to terminals and the software used to power those terminals. I'll add a third and say that the external environment is very favorable towards them as South Africans continue to move towards digital payments, virtual cards, and the like. All of this is really supportive of a business like Capital Appreciation. Why not to buy Capital Appreciation? Okay, so they have a software business where there's excess capacity at the moment, so there's some margin pressure coming through there, and there's a risk that they don't get the big contracts required to fill that capacity. It's a really good business, so it would be great if they are able to continue to incubate and grow that side of the business, but there's a risk that they won't be able to do that because of the external environment. And then the second reason is I think that the terminal space is seeing a lot of competition. It's certainly heating up a little bit. So they just need to be cognizant of that in order to continue to maintain that really strong market position that they are in at the moment.
Okay, so I'll give you a different question then, Victor. Let's chat about Sasol. Is it worth buying at these levels? Now, the viewer says purely off the view that it will be unbundling its chemicals business and with the hope that it could be another we buy cars and transaction capital kind of story.
Probably not going to be a we buy car story. It's not a high profile or for a clean balance sheet. I'd say, yes, it's a turnaround story. Continue to turn around. You would have to have faith in management's ability and will to execute its turnaround strategy. Sasol is in need of far better operational performance, stricter stricter implementation of cost controls, and improving their mining division's performance. They need to improve the quality of coal. So they set this out at their capital markets. They're improving the coal that they produce, the quality thereof. They've got this destoning project, and in order to ensure uptime of their plant, their gasifiers. So there's significant room for them to improve their operational performance and to reduce cost. It's positive that they are unbundling underperforming chemicals businesses. They do expect pricing pressure going forward in the chemicals business. So that's a positive move that improves the quality of the business. So I do value Sasol slightly above where it is trading at the moment. So yes, a modest position in Sasol is one that one could take.
And are you buying into that turnaround story, Chantal?
Not entirely. So I understand what they are trying to do, and I buy into the interventions that they've noted to the market so far. I guess my only concern is still feedstock supply and security of supply. And by feedstock, I mean that the coal they require to turn it into petroleum, the gas that they require to turn it into petroleum and other products, we don't know where it's going to come from. There's a gas cliff in South Africa. The gas supply that they're getting from Mozambique is going to be limited, and we don't have clarity in terms of how that is going to evolve. In terms of their own coal mines, they're facing operational issues there, and they continue to have to buy in coal at a higher cost. So those are two issues, or basically the two of the same issues that really keeps me from becoming bullish on Sasol stock.
And I know you're big on Boxer, so I'll start off with you, Chantal, with your long-term view and prediction of the Boxer share price. Is it a buy at these levels? The viewer then goes on to say that they think Boxer could be the Capitec of the retail space.
Yeah, I mean, so Boxer they're excellent operators, and they understand the market that they are in extremely well. The store rollout plan is pretty ambitious, and I think that they'll be able to meet that. And if you take that into account, the store rollout plan, along with other external dynamics, and the fact that they're moving into underserviced markets, I think that you can fairly assume that the company will be able to grow earnings by between 15 and 25% over the next 5 years. So that gives you a really strong growth profile and justifies a higher PE rating that it's trading on currently. But it's not cheap. It's not a cheap stock to buy. So if you're not in the stock, I would actually see if I can find a slightly better entry point, wait around a little bit. If I'm in the stock, I'd probably hold on to it.
All right. Then there's a question then on Pick n Pay, Victor. We get this one a lot, just on the back of Chantal's thoughts around Boxer being expensive. The viewer then asks, would you rather get your Boxer exposure through Pick n Pay at around that 30 Rand level, or straight through Boxer at around that 70 Rand level?
No, I'd rather go direct. I'd rather have undiluted, direct access to a high quality, high growth business in Boxer than have my returns diluted and possibly destroyed with Pick and Pay, whose competitive position continues to deteriorate, I would say, in relative terms. If you look at the ongoing market share gains that are being made by ShopRite, by Boxer, as well as even Woolworths Food. So I think, yeah, Pick and Pay, I would expect to continue to struggle.
And Chantal, would you pick up some Spar at these levels?
No, I think that Spa is also one that I'll leave alone for the time being. I think that there's actually a much better opportunity to pick up ShopRite at a reasonable price right now.
Yeah.
And given the quality and diversity of that business and continued market share gains, I would much rather think about buying ShopRite currently within that food space than I would Spa. Spa, I think, has an interesting it's an interesting story, and you can probably do very well in Spa if they get a few things right, including the successful divestment from Switzerland, as well as the southwest England business that they are in as well, because the Ireland business that they're going to stay in is pretty solid, and they have staged a decent turnaround in South Africa. But it's a multi-year story, so you could actually be stuck for a year or so in a stock that goes absolutely nowhere, and there's obviously execution risk attached to that as well. So I'd rather just go for the cream of the crop.
And then in addition to Spar, Victor, would you look at picking up Woolies, right? The viewer says just with that exposure into the food market and that food business, that's doing really good.
Yeah, so unfortunately, food is only part of the Woolworths story. The other part, the food, beauty and home business, is a business that is dragging significantly on the group. Unfortunately, the strategy in the clothing business hasn't been the best. Yeah, one wonders whether Woolworths learned its lessons because in the mid-2010s, they bought a department store business in Australia, and some of the merchandising strategy that they're adopting in South Africa suggests a bit of a move again towards departmentalization with the introduction of third-party brands. That is very concerning. I would like to see management express more faith and conviction in their own labels, because those are higher margin products, and inject some revitalization into their clothing offering, because historically it was good, but yeah. So I wouldn't be very bullish on Woolworths as a whole. If they carved out their food business, yes, I would. But we know that ShopRite is making formidable moves in that space as well.
All right.
So it's going to be more competitive.
All right, let's get into your stock picks. So not bullish on Woolworths. What are you bullish on? Where are you seeing opportunity at the moment, Victor?
I think my stock pick would be Richemont. I think it's a very well-run luxury business. Yes, it has had hiccups in the past, like going into online retail and so on, but it owns the most prestigious luxury jewelry brands in the world, brands that are, because of the heritage and the innovation, very hard to replicate. So very high competitive moat in the jewelry businesses. Their watchmaking business is not nearly as good as jewelry, but they have strong names in the watchmaking business, which is a lot more competitive. But overall, it's well run. It's got a very strong balance sheet, always run with net cash. And I think that the customer segment that it targets the top 1-2% of high net worth individuals in the world. And we know that that segment of the high net worth population is the segment that's grown its wealth by the highest percentage among all cohorts of high net worth individuals over the past 2 decades. And so, and we continue, as wealth grows both in developed and emerging markets, we'll continue to see their customer group grow. So that bodes well for Richemont going forward. I think it's on a PE of about 22 now. A fair PE, in my view, is about 27. So I think there's a fair amount of upside in the stock.
Okay, let's get your stock pick then. Chantal, what are you hanging your hat on this afternoon?
Well, I'm a bit jealous of Richmond because that is a really great stock pick, Victor. But I'm going to go for an area of the AI thematic that is very unloved at the moment, and that is the software side of things. So Salesforce is probably my preferred pick in software at the moment. These companies are benefiting from AI. They've already made their investments. They're entrenched in the way that businesses globally operate, but they're not being given credit for that at all. These companies are now being seen as being easily replicated or replaced because of the advent of AI, but they're actually utilizing this technology to their advantage and becoming more important to businesses than ever. And if you're a South African investor and you don't have a global trading account, an alternative to Salesforce would be Adobe. Adobe, of course, there's an FNB ETN that gives you exposure on the JSE to Adobe. They're in exactly the same boat.
All right, so Salesforce and Richmond. Chantal, Victor, thanks so much for joining me this afternoon. Now, that was Victor Seanie from Benguela Global Fund Managers and Chantal Marx from FNB Wealth and Investments. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.